Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler, hanging out here with Jim Wood. And we're talking money and investing.
That's what we do.
That's what we do around here. Yeah. And hey, by the way, one of the things I want to do is just say thanks for tuning into the Investor Coaching Show. If you miss any part of the show, you can, we're here live on Saturdays, but if you miss any part of it, you can subscribe to the podcast at paulwinkler.com. Or any place that you get your podcast, and you can watch the show. If you want to watch the show, because we have a beautiful set here, you can watch us on YouTube. So check it out right there.
The comfy chairs.
It is really comfy. I am totally relaxed about money over here. I love these.
You probably don't know why that's funny, but
what's that?
Some people out there do. So bring out the comfy chair.
I have no clue what you're talking about.
Exactly. No, it's a Monty Python thing.
Okay, I will take your word for it that it is something on
Somebody
TV.
out there got that.
People know that I'm not big on TV, and it's going to get even worse because I'm going back to school. So matter of fact, we had our first little thing this morning.
Yeah? Huh?
It's exciting. The next 3 years is going to be really exciting. Leviticus, PhD. Yep. I am piled higher and deeper. Yeah, that's what I'm looking for. I just love it. I've got a master's, of course, those of you that follow the show, master's in psychology, marriage and family therapy, and then 8 financial planning degrees and an economics degree on top of that. I'm just a student. I love the academics.
Well, and that was one thing I've always thought highly of you, and it's something that I try to incorporate is always be learning something. Now, I haven't gone back to school for higher degrees.
Well, you can be learning without getting a degree.
But we're always studying. We're always doing that. And I do other things. I mean, I've been trying to learn the piano. I've been trying to learn Italian. I mean, I just had a talk with my son who just graduated. Congratulations, Angelo.
Yes, Angelo. Woo.
And that's a mindset to serve you through life is, just always be learning. There's a guy that I follow on X, Mike Cernovich, that I picked up something from him one time. Just like every year, try to learn a new skill.
Right.
And I just thought that was so great. And that's after reading that's when I said, okay, we have this piano sitting in the closet. I'm going to learn to play it.
Yeah.
And just something, you just grab onto something, always you'll enhance your life, the life of others. You'll keep your mind sharp. That to me, that's super important. And I think that's great the way you apply it in terms of, okay, how can I do something that I both find fascinating and that's going to help all my clients?
You just reminded me of something. I remember, and some of the times these motivational people I can give or take, I can take them or leave them. But there was one that actually got into this talking about how people take action and how they tend to view life. And it was fascinating because number one, you'll have 6 different ways that people tend to do things. Now, number one is that I need certainty, and I might approach life in a way that I'm seeking certainty. And the reality of it is life is uncertain, and it can be really difficult if you're always trying to seek certainty, simply because there is so much uncertainty in life. But the point that he made was that you won't always be in that mode, because if things are always certain, what happens to you? You get bored. And that leads us to the second thing is some people will they'll seek variety. You might have thrill seekers, and they're seeking uncertainty. And that's what kind of floats their boat, is that idea. Then the third type of person that you run into out there is somebody that is seeking connection. They're just trying to connect with people. And the type of person that is always trying to just, get the relationship with people. Some people are after, they have to be special. and they have to be unique, and they have to, I remember one guy explaining it this way, because I thought that was me at first, and he goes, Paul, no way, that is not you. And I said, well, what do you mean? And he goes, well, he says, I have a client of mine that has this yacht, and he goes up and down the coast in California, and he honks his horn trying to get people to look at him. And I thought, okay, you're right, that's not me. It was significance was the word that he used. The fifth way that people approach life, and he made the point that very few people go down this road, and it's really great if you can start to look at life this way, but it was not one of growth. You're trying to grow, and you're trying to just move yourself forward. And I remember doing a commencement speech one time, and I told the kids, I said, just keep learning, take a new class each year, keep going forward, keep moving forward, add to your level of knowledge, because it makes you more important to other people. It makes you more valuable to other people. And so continue to grow in that particular way, because number 6 is to actually be other-centered, to contribute beyond yourself and be others focused, try to actually make other people's lives better. So I thought that was a really good tutorial, the 6 ways that we approach life.
And I think something that you mentioned I'll add on is acquiring new skills. And Scott Adams, I think, was just one of the most phenomenal thinkers of our time.
Sure, yeah.
Talked a lot about that, about acquiring a skill set, a diverse skill set, because that makes you more valuable. Like, he was a cartoonist, but he had multiple other skills, a public speaker, et cetera, and that brought him a certain amount of success. And that's just the more skills that you can add on to your set makes you, exactly what you said, more valuable to other people, which means that you can go out and get a better job if that's what you want. You can help more people if that's what you want. You can be a better husband, father, et cetera, whatever that is, as you acquire more and more skills over your life. So always be acquiring some kind of new skill is just phenomenal advice.
But and the reality is, when we're dealing with, let's say we're thinking about ourselves and our personal situation all the time, it's where a lot of anxiety comes from. A lot of fear of the future. Because I'm worried that, that what people are going to think of me. I'm worried about what is going to happen. I'm worried that I'm going to lose something. I remember this one guy put it this way. He would ask people to pull out these cards, and he would say, okay, what I want you to do is, and he might have 7 or 8 cards, index cards in front of him. And he says, what I want you to do is write on those cards, who am I? And I want you to come up with, from a very surface level, I'm a financial planner. And then down to really deep, something deep about you, something that really makes you who you are. And what he wanted to do is he wanted to make the point that a lot of the things we define ourselves by are things that are tenuous, things that can go away, things that are not necessarily permanent. And what he said was that a lot of the anxiety that we feel is the worry that those things will change. So therefore what happens is, when I am thinking about myself and I'm anxious about losing something that's me, that can be really depressing. And anxiety leads to depression. It's anxiety with hopelessness is what depression is. And I had no plan in going down the psychological path this segment, but I just thought I would hit that really quick, because I think it's super important to get, why is it that we worry so much about the future? And a lot of it's because we're thinking about ourselves and our personal situation rather than being others focused.
And I think that's why people worry about markets. Same thing. There's so much in life that we can't control.
Oh, yeah, for sure.
But people have this existential dread about, okay, it's all going to come crashing down somehow.
That's why people watch, 24/7 news.
Yeah. And
what's going to happen next? Where are things going to go? Am I going to be
possible.
okay?
I mean, the meteor could hit, whatever, all that, but it's not likely, and you can't live your life that way.
Right. And they're not going to give you any of the good news. That's just not how they operate. So anyway, let's get on the investing topic right here. So I think that this is really fun. One of the things that we often talk about is that there are certain rules of investing. things that we know to be true about investing that, you hear it all the time. Don't stock pick. Don't try to figure out which stocks are better than others. Don't try to figure out which companies are going to have higher returns than others. You may look at technology companies and go, oh, the future is this company, this tech company, or this computer chip company, or this space company, or whatever. And you may be right. That may be the future, but that doesn't necessarily mean that investment will go up in value. Because those companies are using your money. They want to pay you as little as they possibly can for the use of your money. Is the reality of things. But what ends up happening is that people get sucked into that whole thought process that I need to get the next hot stock and buy into that company, when the reality is that company can come crashing down, bam, just like that tomorrow. The other thing we tell people not to do is don't try to time the market. Don't try to figure out when the market's going to go up or when the market's going to go down. As one wise academic once put it, he said, more money has been lost trying to predict market downturns than has been lost in market downturns. So you got to be really, really conscious about not trying to figure out where things are going to go next. And then, of course, costs costs don't matter. Sometimes the investing world is, hey, don't worry about that, that 3 or 4% expense in that variable annuity. We'll overcome it and you won't lose any money, all that kind of junk.
Yeah. And then the flip side of that, of course, is that cost is the only thing that matters.
Oh, yeah, exactly.
Right?
That's the other side of the coin.
Both ways. Absolutely. But yeah, they'll try to sell you something with ridiculous costs and just don't look at that man behind the curtain.
Right. For sure.
But then there's the other side of that that just says the only thing that's focused, this fund is the cheapest one, so you should own it because of that.
That's right. But it sells. That idea sells for some fund companies.
Oh, absolutely.
That's all they focus on because people believe that that's all you should be focused on. And then the other thing is, looking at track record. Just because somebody has done well in the past, somebody has had a good track record in the past where maybe they did beat the market for a period of time. There was one fund manager, Peter Lynch, beat the market 11 out of 13 years. And everybody thought, oh, this guy's a genius. And he did the smartest thing ever as an investment manager. He quit. Then you can't track him anymore. And then there was another guy, that Lake Mason Value Trust, Bill Miller. Bill Miller beat the market pretty much every year. And then all of a sudden, for 15 years. And then all of a sudden, people started hearing about him. And then all of a sudden it came crashing down. So these are things that we teach on a regular basis out there. Well, there was an investment manager that was actually on TV this week. And I thought we'd just go through what he had to say about how to manage money going forward, because there is an adage that we often hear in the investing world, and it is, here it is. I'll just let you hear it.
Let's talk about the markets broadly. We are looking at new highs, not just for the Dow, the S&P 500, the NASDAQ. We're also talking the NASDAQ 100, the Russell 2000. Oil prices have come back substantially, and yet you think that sell in May and go away might be the right thing to do.
So she's setting them up because that's when they're guests on the show. That's what they'll do is they'll say, hey, here's what I want to talk about. So she's setting him up to talk about what he wants to talk about is sell in May and go away. And the idea being that, stock markets, they go into a swoon in the summer and, typically they'll go down in value and, because people aren't really paying attention to the market a whole lot during the summer months. And then, you get to the fall and then people start to, they start to pay attention again and they get back in. It's a myth. I've talked about that several times on the show. The idea that you sell in May and go away, it works about 1/3 of the time or 1/4 of the time, which is the amount of time that markets go down. 1/4 of the time, markets are going to go down. 3/4 of the time, they're going to go up. So most of the time when you follow, that's bad advice. But, people hear this kind of thing and they go, oh, well, yeah, sell in May and go away. Let's do that.
They must know something.
So let's hear what he has to say about this.
Why is that?
Yeah, as long as you just go away for 6 months, I think it's a pretty good idea. But
so you go away, Jim, for 6 months, and it's a pretty good idea.
Sounds like a nice vacation.
Well, what happens, though, if somebody says, next month, after 6 months, the market's going to go up, and they get in 5 months. And then the market goes up, and you're not there because you were going to wait for 6 months.
Yeah. Well,
yeah.
the whole idea, I'm gonna 6 months. That's not go sell in May and go away. That's get back in before Christmas. I mean,
Yeah, that's pretty much what he's saying there. But
Yeah.
let's keep going.
But that said, for us, it's more about rebalancing the portfolios than really getting out of the market. I've never been out of the market 100%.
So he's talking about rebalancing the portfolio. So number one, it was sell in May and go away. Then it was rebalance. And rebalance is, I have half my money in this area of the market. I have half my money in this area of the market right here. Let's say I have half my money in stocks and half my money in bonds. And all of a sudden stocks go down in value. And now it's only taking up 40% of my portfolio. And now my bonds are taking up 60% of my portfolio. So I'm going to rebalance. I'm going to bring it back into balance. I'm going to bring it back to 50-50. So the overage where I'm at 60% in bonds, I'm going to bring that back down to 50 and I'm going to bring the stocks up. So the idea is that I buy low, sell high. Well, that's the idea of rebalancing the investment portfolio. And now he switched it to that. And he said, well, wait a minute, I've never been completely out. Well, that tells me that he's moved a lot out, which is still a form of market timing, which is called tactical asset allocation. If you believe that the market's going to go down, why would you leave anything in there?
Well, that, and just that he's saying, well, I really mean by rebalance at the time. So to me, he's all talking about market timing. Unless you have a systematic approach to how you rebalance, you're just doing it, well, based on what the market looks like. Well, it's May and the market looks choppy, so I'm going to rebalance now. Mm-hmm. That's an arbitrary market timing decision. That's not an academic decision. That's not okay, it's, the end of the quarter and we're going to look, as our portfolio 5% above or 5% below its target, which would trigger that automatic rebalance. That's an academic type of approach. What he's talking about is just another form of market timing.
So what Jim's talking about right there is, if we're dealing with rebalancing and it's 5% deviation, well, let's say if you have, five different asset categories in the US, let's say, and you have, let's say 20% of your money in each of those 5 categories. Now we're going to say if one gets to 25, that's a 5% deviation. We've gotten 5%, it's at 25% versus where it's supposed to be. And that can trigger a rebalance. So you might have and now I'm not using that as necessarily being the number that you would use, but I'm just saying that's what he means by that. The research shows that if you rebalance in that manner, which is it gets off of what it's supposed to be, the target, by a certain amount, the expected benefit of rebalancing can outweigh the cost. So go back to what he has to say here.
Unfortunately, even during the financial crisis. But that said, I think when you're an investor,
pretty tough at the time.
Yeah. But, I think for investors, you have to look at what's your risk tolerance. In up markets, like, my fund GK and my own personal investments and for clients have done so well in the last 2 months. When you're that happy about the market, you have to think opposite, which is I got to get more prudent, and this is from 33 years of experience investing.
Okay, so he makes a point here, which I think is actually valid. A lot of times people talk about taking your risk tolerance. What is your risk tolerance? Well, he says I'm bulletproof. After the market goes up, I'm bulletproof. I think, hey, the sky's the limit. It's going to go up and it's going to keep going up. After the market's goes down, we tend to get very, very scared. And that works against investors because after the market goes down, I want to sell. After the market goes up, I want to buy. But then he says, what we're going to do is we're going to act contrary to that. I'm going to try to go opposite of that. Now, contrarian investing is a thing. There's only one problem. The research on contrarian investing shows it doesn't work. Because you got to be right twice with market timing. You got to be right when you get out and you got to be right when you get back in. And people have a hard time being right the first time, let alone the second time when it gets down to it. But, number two, the other thing about that is he used the word prudent. And I think that's just hilarious because there is something called the prudent investor rule, which was put out there by the American Law Institute that tells you not to do what he's telling people to do.
Yeah.
It's just hilarious. So let's keep going.
I'm doing too well. I start, getting nervous. So it's kind of the opposite reaction that most people have. And that's why I'm a professional money manager. So, I really highly recommend people to look at their risks. People's risk tolerance grows, when the market's up. They're like, oh, I love risk until it goes down. And we just know from, 2022, when we had rising inflation and rising interest rates and a war, that we have the same scenario potential in the next 6 months to a year if we don't work these things out. So I'm hopeful that we'll work things out.
Now, I think just before he goes in this last part right here, I just want to make the point that it was really funny. He made the comment that he lost a bunch of money in the banking crisis, those years when the market had that big downturn. And yet he's going to be right about this when he was wrong about the last one.
Well, and he's not, his whole thing is emotion. Nothing he is talking about is based on data, numbers, anything. It's just, the market seems like it's up and it's making me scared, so I'm going to sell a bunch of stuff.
Oh, that's so good. Yeah.
That's the last person I would want investing my money. Somebody who's,
but he's got 30 years experience here, Jim.
33. So it just, you want to have a portportfolio that's going to take you.
I think he's got 1 year experience 30 times, but anyway, that's just me.
Up and down markets. Just completely lost my train of thought.
No, that's all right, man. Just
so
listen to the end of
I'm not
this.
a bear, but I think if you rebalance or sort of sell in May and go away till after the midterms, remember we have an election cycle here and markets hate this. And so when that gets resolved in November, I think it'll be a much better time to invest.
Okay, so after the election happens, that's not the way things work. That is not the way things work. What happens with elections is that just as we start to approach the election, this is how markets really work. What will happen is lots of polling comes out. And that polling kind of gives us an idea where the election will show up or where it will land. Let's say, just for the fun of it, that candidate A is going to be good for the stock market. That is, in general, what the market believes is candidate A is going to be good and candidate B is going to be bad. If it all of a sudden candidate B looks like they are ahead in the polls and they're looking like they're going to actually win the election, stocks will go down before the election actually takes place. This is how stuff really works. If, on the other hand, candidate A is winning, the stock market will go up in anticipation that they will win. So again, it shows just a disconnect on how markets really work. So let's just hear his final comment here, because I think this is where the rubber meets the road and it's kind of funny.
But we'll see. I don't try to time markets and I don't try to tell you what the future is going to be because I know I can't do that correctly. And that's why you just have to invest where you're comfortable as far as your asset allocation.
So there it is right there. I don't try to time the market. The entire segment has been about market timing.
How he's going to time the market. But
and
I don't do that.
I don't try to time the market, man. Not me. That's not what I do. And I don't tell you how to invest. Well, people are going to listen to what he's telling people on how to invest.
It goes back. Where is the evidence? Where's the data showing that markets lose money all the time before an election? Maybe they have in some, maybe they've even more often. But I'll bet you if you look at the data over time, you pick some long period of time.
I've done that before. We'll talk about it after this break.
Yeah, that it's gone up. Maybe it's gone up less, but I'll bet you it's gone up.
Yeah, there you go. Hey, just a note to you podcast folks. We just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
investor.com/relax.
All right, we are back here on the Investor Coaching Show. I'm Paul Winkler, and he's Jim Wood. We talk money and investing around here. And you can always check out the show not only here, but subscribe to the podcast at paulwinkler.com or wherever you get your podcasts there. And you can check out the show live, the video, what it looks like when we're sitting here live doing this show. You can check it out on YouTube because we actually have video of us, blabbing back and forth. And you can look at Jim's legs today. There you go. Oh, man. So before we went to the break, we were talking about the elections, and you said something about that the data on elections, what markets do. I'd actually had done that, and it was pretty much indeed, Jim, exactly what I would have expected. About 3/4 of the time, the market went up before the election. Just about 1/4 of the time it went down, which historically, you look at markets, that's what they do, So I love what Burton Malkiel from Princeton used to say about stock markets. He said, it's like a gambling casino with the odds in your favor. It's kind of the way he would say that. In other words, when you go to a gambling casino, if you're the person that owns the gambling casino, you're loving it because all you care about is that people play the game, that they jump in there and they get on the slot machines or they go to the craps tables or whatever. Whereas with the stock market, markets go up and they go down. And the reality of it is they go up more than they go down. So historically, when we look at longer periods of time, we see those returns are pretty consistent, but they're terribly inconsistent over short periods of time, and they always have been that way. That's just the way markets are. They've been up and down and back and forth, but on average, they tend to go up more than down. And, you might even have an intra-year downturn. In other words, the market goes down inside of a year, and we've talked about that before, 5% downturns, on average, happen about 3 times a year. 10% downturns happen about once a year, and that's intra-year, means it goes down 10%. But by the end of the year, most of the time the market's still up.
Last year, perfect example of that. Back in
totally.
March and early, all the tariff talk and everything, and look how the year ended up. Phenomenal year, particularly in international.
Oh, yeah, for sure. And, we had this year as well. We had a little bit of a downturn.
Yeah. And
then, the S&P anyway. But a lot of areas didn't go down. So, when we say market, I'm really adamant that we don't... what we're talking about when we're talking about the market, we're looking at global markets. We're looking all around the world because, the reality of it is a lot of these countries around the world, they're just not going to move in lockstep with the U.S. There's been some interesting movements in the market in recent months and recent years. Like last year, for example, where international markets did phenomenally well, where U.S. was okay. But it wasn't nearly. I just finished the workshop. We teach a workshop where we walk through how markets work and returns. And I updated the data on everything just recently, and I had some real fun with a Wall Street Journal article, Jim. There was this article in the Wall Street Journal that was talking about these prognostications for 2025.
Always fun.
What's going to happen. 2 of the 10 prognostications were that the market was going to be volatile, which I got a kick out of. Another one was
the sky will be blue, the grass will
grass will Another one was that large U.S. stocks, growth stocks, were going to be the place to be. And then the other one was large U.S. stocks may be overvalued. You may not want to get out. I was like, which one do you want to follow? And then, there were just back and forth. And it was funny to me how in one way or another, none of them were right. Except for the one about volatility. The market will be volatile. That was right.
Yeah. Hard to miss with that one.
It's just hard to miss. It's going to happen. That's the way markets work.
Well, there was an economist that we used to follow too that would always put out he'd line up the predictions every year, then he'd track them, and you'd see which ones came true and which ones were false, and he'd rank them. Yeah. And inevitably, they were more wrong than right year after year after year. And these are the people that are paid 6 and 7 figures to make these predictions.
And the ones that were right didn't repeat. That's the one I always love.
And there was an economist that I used to hear speak at conferences and stuff that always used to say, economists don't make predictions because they're right. They make predictions because people want them to.
Yeah. Oh, that is so true.
Yeah.
And they predicted 9 out of the last 3 recessions.
Yeah.
Yeah. You got to love that too. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.